Have you ever stopped to really think about the raw materials that make the world go round? The food on your plate, the fuel in your car, the very metals that build our cities and technology. These aren't just everyday items. They are the foundational commodities of the global economy.
Absolutely fundamental.
And their markets are incredibly dynamic. They're influenced by forces as local as, say, a drought in one farming region, or as global as shifting international politics.
Right. It's a huge web of connections.
Investing in these tangible assets offers a completely different dimension compared to, traditional stocks and bonds. And it's something really worth understanding.
Definitely. It's a whole different asset class.
So we're about to take a deep dive into this fascinating world. We're specifically focusing on three major players: gold, oil, and the key agricultural commodities like corn, soybeans, and wheat.
The big ones.
Yeah. And we've gathered a substantial stack of sources for this. We've got analyses comparing different asset classes, even looking at something as concrete as farmland versus the stock market.
That's an interesting comparison.
Detailed guides on specific commodities and their markets, and breakdowns of the popular ways you can actually get involved.
Yeah.
From trading complex instruments to using more accessible things like ETFs.
Yeah, exchange-traded funds. They've really changed the game for many investors.
Our mission here is to cut through the complexity, pull out the most important knowledge, and help you understand the fundamental dynamics, the risks involved, and, of course, the potential rewards of adding these tangible assets to your investment thinking.
Kind of demystifying it a bit.
Exactly. Think of this as your shortcut to being well-informed on a critical part of the global economy. So let's get started.
Sounds good. Where do we begin?
All right, let's unpack this. At the most basic level, what are commodities? And, what's the fundamental case for even thinking about including them in an investment portfolio?
Okay. Well, at their core, commodities are tangible assets. They're the raw materials that are absolutely essential for the global economy to function.
Tangible meaning you can touch them?
Pretty much, yeah. We're talking about things pulled from the earth or grown from the soil. Think a barrel of crude oil, a bushel of wheat, an ounce of gold.
Right.
Like you said in the intro, they are among the very oldest goods traded in human history. And their fundamental role as the building blocks of manufacturing, food production, energy, that hasn't really changed, despite all the tech advancements we've seen.
Right. So the literal stuff the world is made of and runs on.
Yeah.
Given that, why would someone consider investing their capital here alongside maybe, stocks or real estate?
Well, there are several compelling reasons that the sources really highlight. One is pretty straightforward: portfolio expansion and the potential for gains. These gains can be driven by the underlying growth in global demand.
Meaning?
As the world's population grows and economies develop, the demand for fundamental resources like food and energy naturally increases. That can push up the value of these commodities over time.
That makes sense. More people, more need for food and fuel. Simple supply and demand.
Exactly. Another critical reason, and one that gets a lot of attention, is the potential to hedge against inflation.
Oh, the inflation hedge argument.
Right. Tangible assets, commodities included, often tend to retain their value or even appreciate during periods of economic uncertainty or high inflation.
How does that work exactly?
Well, when the purchasing power of your currency, say the dollar, is eroding, the value of a physical asset like a barrel of oil or a bushel of corn or an ounce of gold might hold up better. Its value isn't just a number on a screen tied to a currency. It's tied to its real-world utility and its scarcity.
So they can act as a kind of real-world store of value when money itself feels less stable.
Precisely. Diversification is another major driver mentioned. The performance of commodity markets might not correlate directly with broader financial markets like the stock market.
Meaning they don't always move in the same direction.
Exactly. We'll see a great example of this later when we look at that comparison between stock market performance and farmland values. They moved very differently over long periods. So if your stock portfolio is struggling, your commodity investments might be performing differently, providing some balance and potentially smoothing out your overall portfolio returns.
That counter-cyclical behavior can be really valuable for managing risk.
It really can be. Then, of course, there's also the element of speculation.
Betting on price movements.
Yeah, the opportunity to profit from anticipating price trends. These trends are driven by all sorts of things: global events, supply disruptions, weather patterns, economic cycles.
Yeah.
And it's important to remember these markets aren't just for speculators. For participants directly involved in the commodities world, like farmers, manufacturers, airlines, these markets serve a vital function for risk management.
Oh.
They can use tools like futures contracts to lock in prices for the future, protecting themselves from unexpected price swings. A farmer, for example, can hedge against a potential bad harvest or falling prices by locking in a selling price now.
Or an airline hedging fuel costs.
Exactly. An airline can hedge against rising jet fuel costs by locking in an oil price. It brings some predictability to their costs.
That risk management aspect really shows these markets are more than just places for investors to trade. They have a fundamental economic purpose.
They absolutely do. They're crucial for managing price volatility in the real economy.
Okay, so if someone is convinced of the potential benefits, how do they actually get exposure to these markets? The sources lay out several different ways, right? Methods that apply across different commodities, although maybe the specifics vary.
That's right. There are a few main routes.
Okay, let's walk through those methods. The first one mentioned is direct ownership.
Yes, physically owning the asset itself. This means buying actual gold bars or coins, or perhaps owning land if you're interested in agriculture. It's the most tangible form of ownership. You actually hold it.
Seems straightforward, but I guess there are catches.
Oh, definitely. The sources are quick to point out the practical limits and, frankly, the significant costs involved. For physical gold, you've got major security concerns, storage costs, plus it can be difficult to sell quickly at a fair price. That's what they call illiquidity.
Hard to turn back into cash easily.
Right, and for agricultural grains, owning large quantities is highly impractical for most investors because of storage, insurance costs, and the risk of spoilage.
Yeah, you're not filling your garage with wheat.
Exactly. And you're certainly not setting up an oil storage facility in your backyard.
Definitely not.
Where?
So direct ownership is mostly for specific cases, maybe physical gold for long-term wealth storage or significant land ownership for farming. What's the next level up?
That takes us into the derivatives markets, starting with futures contracts. This is where it gets more complex.
Futures. I hear that term a lot. What is it exactly?
Well, a futures contract is essentially a legally binding agreement. It's an agreement to buy or sell a specific quantity of a commodity at a set price on a specific future date.
Right.
As we discussed, they originally started for producers and consumers to manage their price risk. For investors, though, futures offer very direct price exposure, and they involve significant leverage.
Leverage meaning?
Meaning a relatively small amount of money controls a large value of the commodity. This can lead to very high gains if the price moves favorably.
But the flip side
Is equally rapid and large losses if it moves against you. It really requires a high level of knowledge, experience, and, importantly, risk tolerance. The risk of losing more than your initial investment is very real with futures.
Wow. Okay, so high potential, but definitely not for beginners. What about options on futures? Are those related?
They are. Options provide a bit more flexibility, perhaps a different risk profile. An option gives the buyer the right, but importantly, not the obligation, to buy or sell the underlying futures contract at a specified price within a certain time frame.
So you don't have to buy or sell.
Correct. This limits your potential loss to the cost of the option premium itself, while still offering upside potential if the price moves your way. It's a more nuanced way to trade volatility or hedge positions, but it still requires a solid understanding of how options pricing works and how it relates to the futures market. It's another step up in complexity from simply buying stocks or, say, ETFs.
Okay, so direct ownership has practical barriers. Futures and options are complex and high risk. This brings us to ETFs, exchange-traded funds, which the sources highlight as being much more accessible for regular investors.
Absolutely. ETFs have really democratized access to commodity markets in many ways. They are financial instruments that trade on stock exchanges, just like regular company shares.
So they give you commodity exposure.
Well, they're designed to provide that exposure in a much more convenient package. The fund structure can vary quite a bit. Some ETFs actually hold physical bullion, like some of the popular gold ETFs. Others hold baskets of futures contracts. And still others might hold stocks of companies involved in the commodity, like miners or oil producers.
So the ETF does the heavy lifting.
Exactly. You buy shares in the fund, and the fund managers handle the complexities of accessing the underlying commodity market, whether it's storing gold, managing futures positions, or holding stocks.
So you get the exposure without needing to, build a vault or learn futures trading yourself.
Precisely. ETFs offer much lower minimum investment amounts compared to directly trading futures. They can provide instant diversification if the fund holds a range of assets, like a basket of different agricultural futures. They're generally transparent, you can see what they hold, and they're easy to buy and sell throughout the trading day, just like a stock.
Seems like a good option for many.
The sources often point to commodity-related ETFs as the simplest tool for ordinary investors looking to get some exposure to these markets. However, there are still things to be aware of.
Like what?
Well, there are annual management fees, the expense ratio charged by the fund, which reduces your return over time. And depending on how the ETF is structured, especially if it uses futures or other derivatives, there can be what's called counterparty risk.
Meaning the risk that the other side of the deal doesn't hold up.
Essentially, yes.
Ah.
You're dependent on the financial institutions involved in the fund structure fulfilling their obligations. Also, as we'll discuss specifically with gold, the tax treatment of gains from certain types of commodity ETFs can be different and sometimes less favorable than for stocks.
That counterparty risk is an important point. You're relying on the fund structure and management, not directly owning the physical asset in many cases.
Exactly. It's an indirect exposure mediated by the fund. Another very common way to get exposure is by investing in the stocks of companies involved in the commodities life cycle.
So buying shares in, say, an oil company or a farming company.
Right. Buying shares in grain producers, oil exploration and production companies, or gold miners.
This is different from directly tracking the commodity price, though, isn't it?
Yes, it's definitely indirect exposure.
Yeah.
Your investment performance is tied to the company's overall business performance. Now, that performance is certainly heavily influenced by commodity prices.
Sure, if oil prices go up, oil companies tend to make more money.
Right. But it's also influenced by company-specific factors, things like management efficiency, their debt levels, their production costs, exploration success, hedging strategies.
It's a lot more variables than just the commodity price.
Exactly. A major potential pro here is the possibility of receiving dividends, which you don't typically get from just holding a commodity futures contract or a basic commodity tracking ETF. Many commodity-related companies pay dividends.
Income potential.
Yes. But the downside is you're also subject to company-specific risks, maybe bad management, a failed project, and broader stock market risks, not just the commodity price risk itself.
So you're betting on the company that extracts or processes the commodity, not just the commodity itself. It's a related but different bet.
Well put. And finally, the sources briefly mention alternative investments.
Alternative investments. What does that typically cover in the commodity space?
This usually refers to more sophisticated options like hedge funds or private investment funds that specialize in commodity strategies. These often employ complex trading techniques, use significant leverage, and are generally highly speculative.
Sounds risky.
They carry very high risk and volatility. They're typically only accessible to accredited investors, people with high incomes or net worth, due to regulations. They are definitely not suitable for most retail investors because of their complexity and the potential for significant rapid losses.
Okay, so let's quickly recap the ways to invest. Direct ownership is mostly impractical. Futures and options are high risk and complex. ETFs offer accessible, easier exposure for many. Stocks provide indirect exposure through related companies with dividends but also company risk. And alternatives are really for sophisticated, high-risk tolerance investors.
That's a good summary of the landscape.
That gives us the lay of the land for how to invest. Now let's jump into the specifics, starting with the agriculture commodities.
Agriculture, absolutely fundamental. We're talking about the crops that literally feed the world, things like corn, soybeans, wheat. These have been traded for millennia.
Really? How far back?
The sources note wheat harvesting goes back maybe 11,600 years, corn domestication around 10,000 years ago in Mesoamerica, and soybeans were central to early Chinese civilizations. These are truly ancient trading goods.
Wow.
They form the backbone of global food security and really economic stability.
Deep history there. And the sources focus on the big three: corn, soybeans, and wheat. Let's start with corn. What's the story there?
Corn is highlighted for its high liquidity, especially in the futures markets. That makes it a major focus for traders. However, as the sources note, it's also known for being quite volatile.
Volatile. What makes corn prices jump around so much compared to maybe other things?
Its volatility is heavily influenced by a couple of key things. Weather conditions, obviously, and government policies.
Okay. And where does all this corn go?
It has multiple major uses. A huge portion goes to livestock feed for animals like cattle, poultry, swine. That's a massive driver of demand.
Right.
Another significant driver is ethanol biofuel demand that's tied directly to energy policies and gasoline prices and usage.
The ethanol mandate in the U.S., for example.
Exactly. And then, of course, it's used in countless food products, think high fructose corn syrup, cornstarch, corn oil.
And the sources specifically note that a significant chunk of U.S. corn production goes into high fructose corn syrup, mentioning it's cheaper than cane sugar and also raising related health concerns. That's a specific demand factor tied to food economics and policy.
It is, and it illustrates how economic factors, food manufacturing choices, and even public health discussions can indirectly influence a commodity's market dynamics.
Interesting. Who are the big players in exporting corn?
Major exporters include the U.S., Argentina, Ukraine, Brazil, France, and Romania.
So quite spread out globally.
Relatively, yes. Prices fundamentally depend on the yearly production levels, how much grain is already stored from previous harvests. Those are the stockpiles, critical weather conditions during the growing season, like droughts or floods, which can dramatically slash expected yields.
Weather's huge then.
Huge. And also the relatively stable underlying demand from those key sectors. Livestock feed, bioethanol production, and food processing.
So its price is a complex brew of farm yields, energy policy, and how much livestock we're raising globally. What about soybeans? Are these similar?
Soybeans tend to have somewhat more stable prices compared to corn, according to the sources, although their production is also quite concentrated globally, primarily in the U.S. and Brazil, which still introduces vulnerability to regional weather or policy issues.
And the uses for soybeans?
Soybeans have a diverse set of uses. They're consumed directly, things like edamame, tofu, soy milk, soy sauce, miso. But most of the global crop is actually processed into two main products, soybean oil and soybean meal.
Soybean meal. Is that for animals too?
Primarily, yes. Soybean meal is a very high-protein animal feed. It's crucial for efficiently raising poultry, swine, and also farmed fish. So soybean meal prices track pretty closely with global meat and fish production volumes.
Makes sense.
It's also used increasingly in vegetarian and vegan meat substitutes and protein supplements.
Right. And the oil?
Soybean oil is widely used for cooking, salad dressings, baking, frying fats, and it's also a key feedstock for biodiesel production. That adds another layer of demand tied directly to renewable energy markets and policies.
So soy prices are linked directly to global diets, how much meat and fish we eat, and also renewable fuel production.
Precisely. The top exporters include Brazil, the U.S., Paraguay, Canada, and Argentina. Prices are primarily driven by that demand for animal feed, the demand for biodiesel, and just like corn, weather disruptions that can unexpectedly impact harvests and lead to undersupply situations.
Got it. And finally, wheat, a global staple for centuries.
Wheat is absolutely critical because it's a primary source of carbohydrates and protein for a massive portion of the world's population. It gets milled into flour for virtually everything we bake. Bread, pasta, noodles, cakes, breakfast cereals.
Basic foodstuffs.
Exactly. There are different types too, like hard red winter wheat, which is often used for bread flour, or durum wheat, which is essential for making pasta. The type matters for specific end uses.
And what are the main price drivers for wheat? Similar to corn and soy?
Many are similar, yes. Weather in major growing regions like North America, Europe, Australia, and the Black Sea region is key. Global stock levels are very important. Consumption patterns matter. But wheat prices are particularly sensitive to geopolitical events.
Geopolitics more so than corn and soy. Why is that?
Well, several major exporting regions are politically sensitive. The sources specifically mention conflicts, like the recent invasion of Ukraine, which is a huge global wheat exporter. Disruptions there have immediate global price impacts. Also, things like export bans imposed by governments or changes in trade policies can significantly affect wheat availability and price. And currency fluctuations also play a big role because it's traded globally in dollars.
So political instability in one region can directly impact the cost of a loaf of bread on the other side of the world.
Absolutely. It's a very clear example of how global politics and commodity markets are deeply intertwined. Major wheat exporters, just for context, include Russia, the U.S., Australia, Canada, and Ukraine.
Okay. Beyond these specific factors for each crop, what are the overall things investors in agriculture commodities need to keep an eye on?
The sources emphasize a few key areas: monitoring historical price performance, naturally, understanding the global supply and demand fundamentals for each crop, Keeping tabs on the broader economic mood recessions tend to dampen demand. And critically, being highly aware of weather conditions and seasonal weather forecasts.
Weather keeps coming up.
Agriculture is one of the most weather-sensitive markets there is, period. You also need to pay close attention to major reports, like the USDA forecasts, the U.S. Department of Agriculture. They release regular estimates on expected production, consumption, and stock levels, globally and domestically, which are closely watched.
Market-moving reports.
Definitely. And also the outlook for exports, which is influenced by trade policies and demand from importing countries. Finally, input costs for farmers themselves, things like fertilizer prices, fuel for tractors, seed costs. They affect farmer profitability and their decisions on how much acreage to plant for each crop, which in turn impacts future supply.
Wow, that's a really complex ecosystem of factors driving these prices. What's the recent outlook mentioned in the sources based on that mid-2025 data?
Based on that specific data point, the expectation was for corn, soy, and wheat prices to be near, or potentially even slightly below, the break-even cost of production for many farmers.
Why was that?
The forecast was linked to expectations of strong global grain and oilseed production, combined with a strong U.S. dollar, which makes U.S. exports more expensive for buyers using other currencies, and ongoing uncertainty around global trade policies. All those factors were pointing towards potentially lower prices in the near term, according to that analysis.
Interesting. Okay, now, how do you actually invest in these specific agricultural commodities? Does it map back to the general methods?
It does, yes. It circles back to those general methods we discussed earlier, just applied specifically to agriculture. Futures and options are very widely traded on exchanges like the CME, the Chicago Mercantile Exchange. They offer contracts for corn, soybeans, different types of wheat, soybean oil, soybean meal, and others.
Direct, leveraged exposure, but risky.
Exactly. Requires significant expertise, capital, and carries high risk. The sources also make an interesting point that sometimes a big increase in futures trading volume can come from speculators piling in, which can potentially cause prices to deviate, at least temporarily, from the true supply and demand fundamentals.
The market getting ahead of itself, maybe?
Could be, yeah.
And the easier options for agriculture.
ETFs are noted again as perhaps the simplest tool for ordinary investors. The sources mention specific funds like the 2-Cream Corn ETF, ticker corn, the 2-Cream Soybean Fund, ticker SOYB, and the 2-Cream Wheat Fund, ticker WheatB. These ETFs typically hold baskets of futures contracts designed to track the performance of those specific commodities.
So you get the exposure without managing the futures yourself.
Right. They handle the rolling of contracts and other complexities. It provides exposure without the hassle of managing individual futures positions.
What about investing through stocks of related companies?
That's another route. You can invest in companies involved in processing or using agricultural products. Think major grain traders and processors like ADM, Archer Daniels Midland, or large livestock producers like Tyson Foods, who are big buyers of feed grains.
But again, that's indirect exposure, right?
Very much so. Your exposure here is tied to their overall business operations, which are certainly influenced by commodity prices, but also by their own efficiency, market position, branding, processing margins, and so on.
And the farmland REITs you mentioned earlier.
Right. Farmland real estate investment trusts, like Farmland Partners, FTI is the example given, these allow you to invest in the ownership of agricultural land itself. While you're not directly investing in the crops, the value of the farmland and the rent it can command are obviously influenced by crop prices and farm profitability.
So another form of indirect exposure.
Yes, another indirect route, with its own set of risks and management considerations compared to directly owning shares in an agricultural company or an ETF tracking crop prices. And just to reiterate, the sources make it clear that buying and trying to store physical grains is highly impractical and costly for most individual investors.
Okay, so for agriculture, the story is about ancient markets, driven by very modern factors like weather, geopolitics, global diets, energy policy, and accessible ETFs seem to offer a key way for many investors to participate without extreme complexity or risk.
That pretty much sums it up nicely.
All right, let's shift gears now. Let's focus on the energy pulse of the global economy, oil.
Oil. Yeah, arguably the most visible and talked about commodity. Its price fluctuations seem to be constantly in the news cycle.
They really are. Why is it so central?
Well, simply put, it's absolutely critical to the modern world. Crude oil is the single most widely traded and used commodity globally. Even as we invest heavily in and develop alternative energy sources, Oil and its derived products, gasoline, diesel, jet fuel, heating oil, plastics still power the vast majority of global transportation and are essential for manufacturing, heating, and cooking in many parts of the world.
Still fundamentally vital.
Fundamentally vital to economic activity as we know it today.
And its price seems incredibly sensitive to global events. What are the main factors driving the price of oil, according to the sources?
The sources point to a really dynamic interplay of three main things: supply, demand, and the influence of derivatives trading and market reports.
Okay, let's start with supply.
On the supply side, a major factor is the alliance of major oil exporters known as OPEC plus TEL, which importantly includes Russia alongside the traditional OPEC members. They attempt to influence global supply and therefore prices by agreeing on production quotas for their member countries.
Trying to manage the market.
Trying to, yes. But geopolitical developments are critically important here because a significant portion of the world's proven oil reserves and current production capacity is located in politically sensitive or unstable regions, particularly the Middle East.
So instability in one key producing region can cause price ripples everywhere.
Absolutely, and often very quickly. The sources cite historical examples: the Iranian Revolution in '79, the Iran-Iraq War in the '80s, the Arab oil embargo back in the 1970s, the Persian Gulf Wars. All these events caused drastic, rapid shifts in oil supply expectations or actual supply, and consequently, massive price spikes.
History shows it's a volatile supply picture.
Very much so. On the other hand, technological innovations have also played a huge role. Think about hydraulic fracking in the United States. That fundamentally altered the supply landscape over the last decade or so. It vastly increased U.S. shale oil production,
Making the U.S. a major producer again.
to the point where the U.S. actually became a net exporter of petroleum products back in 2018. That was a huge shift. Also, financial conditions like the cost of capital and access to credit for drilling companies also affect production levels and investment in new supply.
So supply isn't just about how much oil is in the ground. It's about who controls it, the political environment, the technology available, and the economics of getting it out.
That's a great way to put it. Then there's the demand side.
What drives oil demand?
The price on the demand side is heavily dependent on the pace of global economic growth and industrial activity. When economies are booming, particularly in large developing nations like China and India historically, demand for energy, including oil, tends to increase rapidly.
It's a two-way street, right? Oil prices affect the economy too.
Exactly. Significant changes in the price of oil, especially rapid increases, can act almost like a tax on consumers and businesses. It impacts transportation costs, manufacturing inputs, heating bills, which can, in turn, dampen economic growth and eventually reduce demand for oil.
So high oil prices can actually slow down the very economies that need the oil. A feedback loop.
Precisely. Other demand factors include general transportation patterns, how much people are driving, flying overall population growth, and predictable seasonal changes. Think more demand for gasoline during summer driving season in the Northern Hemisphere, or more demand for heating oil in winter.
Okay, supply and demand are key. And you mentioned the role of derivatives and reports.
Yes, the oil market is characterized by massive trading volume in futures and options contracts. These are used by players like airlines and oil producers to hedge their price risks, as we discussed earlier.
Locking in prices.
Right. But they're also used heavily by speculators betting on price movements. Now, oil prices are notoriously volatile, and part of the reason, the sources explain, is because both supply and demand are relatively inelastic in the short term.
Inelastic, meaning they don't respond quickly to price changes.
Exactly. Think of it this way. When the price of gasoline suddenly jumps, it's hard for most people to instantly stop driving or switch to a more efficient car. And on the supply side, it takes time and investment to drill new wells and bring more oil to market. This lack of immediate response on both sides means that even relatively small changes in the actual supply or demand balance can require large price swings to bring the market back into equilibrium.
That inelasticity is a key driver of the volatility then. Small shifts, big price moves.
That's a core concept. And because of this sensitivity, market reports that hint at future supply or demand changes are watched incredibly closely.
What kind of reports?
Key ones mentioned include the OPEC monthly report, the International Energy Agency, IEA, market report, and very importantly for short-term moves, the weekly U.S. inventory data released by the EIA, Energy Information Administration, and the API, American Petroleum Institute. These reports give clues about production levels, how much oil is in storage, and demand trends, and they can significantly influence short-term market sentiment and prices.
Okay, that gives a clear picture of the forces at play: supply, demand, geopolitics, trading, inelasticity. What about the structure of the oil industry itself? If you want to invest through stocks, what kinds of companies are there?
The sources break down the industry into several key segments, and you can invest in companies operating in different parts of this value chain. Each has a slightly different risk and reward profile.
Okay.
First, there's upstream. This segment covers exploration and production, the E&P companies.
Finding and pumping the oil.
Exactly. These companies focus on finding new oil and gas reserves and extracting them from the ground. Their stock prices are typically the most volatile and the most sensitive to short-term oil price swings. They benefit hugely from new discoveries or high prices, but can be hit very hard by market downturns that make their extraction activities unprofitable.
Makes sense. Then there are the companies that provide the tools and services for them.
Yes, those are the oil field services companies. They manufacture the equipment, provide the drilling rigs and crews, offer testing services, safety tools, seismic surveys, everything that E&P companies need to find and extract oil and gas.
How do their stocks behave?
Their profitability tends to swing with the overall activity levels in the upstream sector, so they generally do well when oil prices are high and E&P companies ramp up drilling and exploration spending. Conversely, they do less well when prices fall and activity slows down.
Okay. What about turning the crude oil into usable products?
That's the refining sector, or downstream. These companies operate the refineries that process crude oil into gasoline, diesel, jet fuel, heating oil, lubricants, and other petroleum products.
How do they make money?
Their profitability is based more on the crack spread, the difference between the cost of the crude oil they buy and the price they get for the refined products they sell. Refiners can sometimes profit when crude oil prices are rising if they bought their crude inventory cheaper in advance. However, they can be vulnerable when crude prices fall rapidly, as they might be forced to sell their finished products for less than the cost of the crude they already purchased and processed.
So the relationship with oil prices is a bit more complex.
It is, and then you have the giants that do pretty much everything.
The big household names.
Right. Those are the integrated oil companies, sometimes called the super majors. They operate across multiple segments of the value chain. They might have significant upstream exploration and production, midstream pipelines and transportation, and downstream refining and marketing operations, all in-house.
Like ExxonMobil, Shell, Chevron.
Exactly. Their business risks are theoretically more diversified across the value chain compared to a pure E&P or refining company. However, their overall prospects and stock prices are still heavily tied to the prevailing price of oil and refined products.
Okay. And finally, the sources mentioned MLPs.
Yes, master limited partnerships, MLPs. These structures typically own and operate energy infrastructure assets, like pipelines, storage facilities, and processing plants.
So they move and store the oil and gas.
Primarily, yes. Their income is often based on the volume of product transported or stored, sometimes under long-term contracts, which can make their cash flows potentially less directly sensitive to short-term oil price volatility compared to, say, an E&P company. Although long-term price trends and overall production levels certainly still matter for pipeline volumes.
And they're known for income.
Yes, MLPs are often structured to pass through most of their income to unit holders, leading to relatively high distribution yields, similar to dividends. This makes them popular with income-focused retail investors. However, their unit prices can still be quite volatile, and their tax structure involves issuing K-1 forms, which can be more complex for investors at tax time compared to standard stock dividends.
Good to know. So investing in oil stocks gives you exposure to different parts of the industry, each with its own sensitivity to oil prices and other factors. If you're looking at a specific oil stock, how should you evaluate it? What are the key things to look for?
The sources list several key factors to consider. First and foremost, obviously, is the outlook for commodity prices. Oil and natural gas prices directly impact their revenue and profit margins.
Makes sense.
Production volume is also critical. How much oil and gas are they actually producing? Often measured in barrels of oil equivalent per day, BOED. And is that volume growing or declining?
How much stuff are they selling?
Right. Dividends and buybacks are important, especially for investors seeking income. These companies, particularly the large integrated ones, often return significant amounts of cash to shareholders, especially when oil prices and profits are high. You need to look at their costs, particularly their finding and development costs and lifting costs, the cost to extract a barrel of oil. Lower costs mean better profitability, especially in a lower price environment. Efficiency matters hugely. Cash flow is vital. Are they generating enough cash to fund their ongoing operations, invest in new projects, capital expenditures, pay dividends, and hopefully avoid accumulating too much debt? Positive free cash flow is generally a good sign. The size and estimated value of their resources and reserves, the amount of oil and gas they expect to be able to produce in the future, underpins the company's long-term value.
What they have in the ground for the future.
Exactly. And related to that, their track record and plans for exploration and prospects, are they successfully finding new reserves to replace what they produce? That indicates their ability to sustain or grow the business over a long term.
Okay, those are the qualitative factors. Did the sources provide any typical quantitative metrics for comparison?
Yes, based on that mid-2025 sector data snapshot, they mentioned some typical ranges for metrics used to compare peers. Things like price to earnings, PE ratios, perhaps typically between 10 and 15, debt to equity ratios, often between 0.4 and 0.7. Looking for positive free cash flow. Dividend yields averaging maybe 3% to 6%. ESG scores are becoming increasingly relevant for many investors assessing sustainability risks. Looking for reasonable production growth, maybe 2-5% year over year, and a healthy reserves life, basically. How many years they could sustain current production from their existing proven reserves, perhaps aiming for 10-20 years. These metrics help compare companies within the sector, but you need to dig deeper, of course.
And they also mentioned some leading examples based on that mid-2025 data snapshot, just to illustrate.
Briefly, yes. Companies like ExxonMobil were noted for things like upstream focus, strong dividends and buybacks, and efforts around low-cost assets. Shell, a huge global player, was noted for diversification, a stated net zero goal, and significant renewables investment alongside its traditional business.
Different strategies emerging.
Definitely. Chevron was highlighted for its U.S. focus, dividend history, and efficiency initiatives like methane reduction. Total Energies, the French major, noted for global spread, also having carbon-neutral goals and aggressive renewables investment, often with a high dividend yield. And BP, the London-based company, noted as undergoing a strategic pivot, rebuilding its portfolio with a focus on green energy like hydrogen and offshore wind alongside oil and gas. These are just snapshots illustrating the variety within the sector.
So, considering all that complexity, should someone invest in oil stocks? What are the pros and cons summarized from the source's perspective?
Well, the potential pros often center on attractive dividends. These companies, especially the established ones, often offer higher yields than the broader market, particularly during profitable cycles when cash flow is strong. They can also offer portfolio balance, as their stock performance might not always move in lockstep with the wider stock market, providing some diversification benefits.
Okay, and the big risks. What are the major cons?
The cons are significant and need careful consideration. Geopolitics is a massive factor. The industry's reliance on operations in and relationships with often politically fragile regions introduces unpredictable risk. The Ukraine war is cited as a stark recent example of how political conflict can dramatically disrupt energy markets, even while causing price spikes that might benefit some companies financially. In the short term, the underlying risk is huge.
Unpredictability.
Exactly. Volatility is inherent in the sector. Oil stock prices can swing dramatically, both up and down, mirroring the volatility of the underlying commodity market. You really need a high tolerance for potential significant losses and price swings.
Not for the faint of heart.
Not usually. And perhaps the biggest long-term question mark is environment and regulation. The global energy transition, however slow or uneven it might be, is structurally moving away from fossil fuels over the coming decades. This could impact future demand for oil and gas, potentially stranding assets, and certainly affects investor sentiment. The rise of ESG, environmental social governance investing trends, is also directing significant investment flows away from fossil fuel equities for some major investors and funds.
So you have high potential reward from dividends and cyclical upswings, but also exposure to geopolitical shocks, inherent volatility, and that long-term structural shift away from fossil fuels.
That's the core tension, yes.
How do you actually access oil investment beyond buying individual stocks?
Well, besides buying shares in those companies we discussed, or using oil-related ETFs, which can hold baskets of oil stocks or track oil futures prices, the sources also mentioned trading using CFDs.
CFDs, contracts for difference. What are those again?
Right. They allow you to speculate on oil price movements up or down without actually owning the physical barrel or even a futures contract directly. You're essentially betting on the price change. CFDs often use significant leverage.
Meaning small investment, big exposure.
Exactly, which can amplify potential gains, but just as easily amplify losses very, very rapidly.
And the sources have a pretty strong warning about CFDs, don't they?
Yes, a very strong warning. One source includes a specific disclaimer noting that a very high percentage of retail investor accounts lose money trading CFDs, with certain providers, the example cited, showed over 82% lost money.
Wow, that's high. Why?
It's due to the speed of the market, the high leverage typically involved, potential liquidity risks, difficulty closing a position at your desired price, and the risk of margin calls. Margin calls can force you to deposit more funds or close your positions automatically, realizing significant losses quickly, potentially even exceeding your initial deposit.
So definitely not a casual investment.
Absolutely not. CFDs are generally considered tools meant only for highly experienced traders who fully understand the risks and have significant risk capital they can afford to lose.
Okay, so for most people looking for oil exposure, sticking with individual stocks, after careful research, or perhaps ETFs that track oil stocks or futures prices are likely the more accessible, if still inherently volatile, options.
That seems to be the consensus takeaway from the material, yes.
All right, we've covered the fields of agriculture and the energy pulse of oil. Let's move to our third commodity, one that's often seen in a very different light.
Gold.
Gold, yes, holds a really unique position globally. The sources highlight its deep significance, giving the example of Indian households, where gold is deeply embedded in tradition, used in weddings, festivals, and serves as a key symbol and store of family wealth passed down through generations.
More than just an investment there. Much more. But more broadly, even beyond that cultural significance, gold is widely seen as a tangible asset that provides wealth preservation, particularly in times of economic uncertainty and high inflation. Its role as a safe haven is perhaps its most famous characteristic in investment circles.
A safe haven? And what does that mean in practice?
It's the idea that gold tends to retain its value, or sometimes even appreciate, when other assets like stocks or bonds are falling, or when currencies are unstable, or when geopolitical tensions are running high. People flock to it when they feel fearful or uncertain about the future.
Why would someone want to add gold exposure specifically to a diversified investment portfolio alongside stocks and bonds?
The primary advantage highlighted across the sources is improved portfolio diversification. Gold has historically shown a tendency towards a low or sometimes even negative correlation with stocks and other traditional financial assets.
Meaning it doesn't move in tandem with the stock market.
Often, yes. When the stock market is performing poorly, gold may perform well, and vice versa. This uncorrelated or negatively correlated behavior can help reduce the overall volatility and risk of a portfolio. It acts as a potential buffer.
Okay, diversification is key. And specifically when it comes to accessing gold investment, you mentioned earlier that ETFs offer significant advantages compared to, say, buying bars.
Yes, gold ETFs are presented as a key innovation that really made gold investing much more practical and accessible for the average investor compared to the traditional methods.
What are those advantages?
They offer excellent liquidity. You can buy and sell shares in major gold ETFs easily on stock exchanges throughout the trading day, just like any stock. They generally have much lower costs compared to buying, storing, and insuring physical gold yourself. You avoid those direct storage fees, insurance premiums, and security hassles.
Convenient.
Big time. They offer daily flexibility to trade. They are generally transparent, operating in regulated markets, and you can usually see how much gold the fund holds. And they are highly accessible. You can invest relatively small amounts of money compared to the cost of buying even a single large gold bar or trading a full-sized futures contract.
So ETFs essentially offer the investment benefits of gold, the price exposure, the diversification potential, without the practical headaches and costs of actually owning and storing the physical metal yourself.
That's the core idea, yes. Which brings us to that fundamental comparison the sources draw. Physical gold versus gold-backed securities like ETFs and futures contracts.
Right. Let's break down that comparison. What are the pros and cons of holding actual physical gold?
Okay. With physical gold, we're talking coins. Bars, the main pro, is clearly the tangibility. You can physically hold it, see it, store it where you want, within reason. There's also no counterparty risk. Your asset's value isn't dependent on a financial institution remaining solvent or fulfilling a contract. You have direct control and a degree of privacy in your ownership.
Sounds good, but what are the downsides?
The cons are significant from a practical investment standpoint. Major storage and security challenges are unavoidable. Where do you keep it safely? This leads to additional ongoing costs like insurance, safe deposit box fees, or secure vaulting fees, plus potential maintenance or assaying costs when you sell, which all eat into your net returns over time. And liquidity is limited. Selling physical gold quickly at a fair market price can be difficult. You often lose a percentage on dealer spreads or making charges, especially for jewelry or small coins, and it's just harder to transact efficiently compared to clicking a button on a brokerage account.
So less practical for frequent trading or rebalancing.
Definitely. Despite these drawbacks, though, that traditional and cultural attachment, like the strong demand in India we mentioned, is a very real factor influencing global gold flows and demand. It's not purely financial.
Got it. Now, what about the other side? Gold-backed securities like ETFs, what are their pros and cons?
For gold-backed securities, the pros heavily lean towards convenience and practicality for investors. Liquidity and convenience are extremely high. They trade easily on exchanges. Lower transaction costs compared to physical gold are a major. Plus, you avoid those direct storage, insurance, and security fees that you'd have to manage yourself.
Makes sense.
They offer easy diversification and accessibility. They're ideal for adding gold exposure to a portfolio quickly and conveniently, and they don't take up physical space. But the cons are also important to understand.
Okay, what are they?
You pay management fees annually, the ETF's expense ratio, which, although usually lower than physical storage costs, still reduce your long-term returns compound over time. There's potential counterparty risk. You are dependent on the financial institution managing the fund, the ETF issuer, or the counterparties to the futures contracts the fund might hold to fulfill their obligations. And for some people, the biggest con is simply the lack of physical ownership. You don't actually hold the real, tangible gold yourself. You own shares in a fund that claims to own the gold or track its price.
So it really is a trade-off between the tangible, secure in your hand, but less practical physical form, and the convenient, liquid, accessible, but intangible securities, which rely on financial intermediaries. The sources seem to put a lot of focus on gold ETFs as the primary investment vehicle for many modern investors.
They do, yes. They're highlighted as providing easy investment exposure for the masses. The fund itself holds gold-related assets, typically physical bullion in secure vaults for the most common type, but sometimes futures contracts or even stocks of gold mining companies, and the ETF's share price is designed to track the price of gold closely.
And the World Gold Council was involved in getting these started.
Yes, the WGC is noted as a key player. It's interesting, the WGC is actually a market development organization funded by the world's leading gold producers. They played a crucial role in promoting the concept and helping create the very first major gold ETF, the SPDR Gold Shares, ticker GLD, back in 2004. They later helped launch others, like the lower COD GLDM.
That's fascinating. The gold mining industry itself helped create the popular investment tool to make it easier for people to buy gold exposure.
Exactly. It's a clear example of how an industry body can work to increase overall demand for their underlying product by improving market access and making it easier for investors to participate. And it worked. Gold-backed ETFs have become a huge source of global gold demand, holding, as one source mentioned, over 3,500 tons of gold by the end of 2022.
Wow.
They've genuinely transformed the gold market by reducing costs, increasing efficiency, improving liquidity, and dramatically expanding accessibility for investors worldwide. Tracking the flows of money into and out of these large gold ETFs is also now a key indicator analysts watch to gauge investor sentiment towards gold.
Okay. What are the main types of gold ETFs an investor might encounter? Are they all the same?
No, they're not all the same. The sources describe several main types. The most common and widely known are the traditional physically backed ETFs. These funds hold actual physical gold bullion, usually bars, sometimes coins, stored in highly secure vaults, often in places like London or Zurich.
So they actually own the metal?
Yes. Examples given include BRR, Granite Shares Gold Trust, AAAU, Goldman Sachs Physical Gold ETF, and GLDM, SPDR Gold Minishares Trust. These are designed to give you the economic benefits of gold ownership, the price exposure, without the hassle and expense of arranging your own physical storage and insurance. They generally have relatively low operating costs, often around 0.4% per year or even lower for some.
Now, there's a crucial tax detail for U.S. investors, specifically with these physically backed ETFs, right? You mentioned that earlier.
Yes, this is a very important point noted clearly in the sources and something U.S. investors absolutely need to be aware of. For U.S. taxpayers, gains on these physically backed gold ETFs, even if held for over a year, qualifying for long-term capital gains treatment for most stocks, are typically taxed as gains on collectibles.
Collectibles, like art or stamps.
Exactly. And under current U.S. tax law, long-term gains on collectibles can be subject to a potentially higher maximum tax rate, currently up to 28%, compared to the standard long-term capital gains rates on stocks or bonds, which are typically 0%, 15%, or 20% depending on income.
Ouch. That's a significant difference.
It really can be. It's a specific quirk of the U.S. tax code regarding how these types of funds that hold physical commodities are treated. It's something investors holding these ETFs in regular taxable brokerage accounts need to factor in, as it can materially impact their after-tax returns compared to other assets, or even compared to other types of gold ETFs that might be taxed differently, like those holding futures.
That's a really key detail for U.S. investors. Okay, what are the other types of gold ETFs besides the physically backed ones?
There are gold miner ETFs. These funds don't hold physical gold itself. Instead, they hold baskets of stocks of companies involved in mining and producing gold.
Like the oil company stocks we discussed earlier.
Similar concept, yes. An example given is the Sprott Gold Miners ETF, ticker SGDM. The performance of these ETFs is obviously tied to the price of gold because that heavily impacts the miner's profitability, but it's also tied to the specific business performance, operating costs, exploration success, political risk in mining jurisdictions, and management quality of the underlying mining companies in the portfolio. The SGDM, for instance, tracks a custom index based on factors like revenue growth and free cash flow of companies like Barrick Gold or Endeavor Mining.
So you get exposure to the gold industry and the companies within it rather than just the pure gold price itself. It's leveraged to the gold price, but with added company risk.
Correct. That's a good way to think about it. There are also inverse gold ETFs. These use derivatives like futures or swaps to try and achieve a return that moves in the opposite direction of the daily gold price.
Why would you want that?
These are typically used for short-term trading strategies, perhaps to hedge an existing long gold position against a potential price drop, or for outright speculation that the price of gold is going to fall. They are complex and generally not intended for long-term holding.
And then there are the potentially high-risk ones, the leveraged ETFs. We touch on these with oil CFDs.
Yes, leveraged gold ETFs. These funds also use financial derivatives and debt to try and multiply the daily return of gold, often aiming for 2x or sometimes even 3x the daily percentage movement up or down. An example mentioned is the ProShares Ultra Gold, ticker UGL, which aims for 2x the daily return of the gold bullion price.
Doubling the daily move sounds exciting, but also potentially very dangerous, right?
It absolutely is. The sources explicitly state that these leveraged ETFs are designed primarily for sophisticated investors engaging in very short-term trading, often literally for just a single day or maybe a few days at most.
So only short-term.
Because of the way the leverage and tracking are calculated and reset each day, their performance over longer periods, like weeks or months, can significantly deviate from their stated multiple, for example 2x, of the underlying gold price movement over that same longer period. This is a mathematical effect sometimes called compounding risk or volatility decay. They are absolutely not meant as long-term buy and hold investments. Holding them longer term can lead to surprising and often disappointing results, even if gold generally moves in the direction you expected.
So really understand what you're buying there.
Definitely. Leveraged ETFs also often issue a Schedule K-1 tax form, which can complicate tax filing for investors holding them in taxable accounts, making them potentially better suited for tax-advantaged accounts like IRAs, where the K-1 isn't an issue.
Good to know. And finally, the sources mention smart beta gold ETFs. What are those?
These are ETFs that track custom-built indexes. Instead of just tracking the gold price or weighting mining stocks by market capitalization, they might use specific smart beta factors or strategies like focusing on miners with low volatility, strong balance sheets, or momentum aiming to potentially achieve better risk-adjusted returns or outperform traditional benchmarks over time. They represent a more rules-based, factor-driven approach within the gold ETF space.
Okay, so there's a whole spectrum of gold ETFs, from simple physical gold trackers to complex, leveraged or factor-based funds, depending on your objective and risk tolerance. If someone's looking at a gold ETF, how should they analyze it? What should they look for?
The key things are, look at the performance metrics over different relevant time periods, 1 year, 3 year, 5 year, maybe since inception. Compare its performance not just to the spot price of gold itself, but also critically to other gold ETFs that follow a similar strategy. Example, compare physical ETFs to other physical ETFs. Pay very close attention to the expense ratio, that's the annual fee charged by the fund. All else being equal, a lower expense ratio is generally preferred, as it means more of the fund's return or less of its loss is passed on to you, the investor. Also consider liquidity, how easily it trades, reflected in trading volume and bid-ask spreads, and the assets under management, AUM, as larger funds tend to be more liquid and stable. And for physical ETFs in the US, remember that tax implication.
Right, the collectibles tax. The sources mention some specific top-performing gold ETFs based on 5-year returns as of early 2024, just as examples.
Yes, they listed 5: IGLD, UGL, BIRR, AAU, and GLDM. It's worth noting, as the source does, that IGLD showed an exceptionally high 5-year return, plus 1927.75% in that specific data snapshot.
Whoa, what's going on there?
The source clarifies that IGLD isn't a pure gold ETF. It has a unique income generation strategy involving holding bonds and using options, like covered calls on gold, which generates income but also caps the potential upside from gold price increases. Its performance is thus very different from simply tracking gold and could reflect specific market conditions, option strategy success, or potentially even data anomalies in that period. It highlights the need to understand how an ETF achieves its returns.
Definitely. What about the others?
UGL is the ProShares Ultra Gold, the 2x daily leveraged one we discussed strictly for short-term, sophisticated traders. Bayer Granite Shares holds gold in a London vault. AAU, Goldman Sachs Physical, allows investing in small fractional share amounts. And GLDM, SPDR mini shares Physical, noted as a particularly low-cost option, are all traditional physically backed ETFs. And for U.S. investors holding them long-term in taxable accounts, they'd be subject to that potential collectibles tax rate on gains.
Okay, how easy is it to actually invest in these gold ETFs? Is it complicated?
Generally, no. It's become relatively straightforward for most investors today. The basic steps outlined are: first, research and select the ETF that best matches your investment objective, considering its strategy, physical, miners, leveraged, fees, liquidity, and tax implications. Second, open a brokerage account if you don't already have one. Most major online brokers in the US and internationally offer access to these ETFs, and many allow you to open accounts easily online or via mobile apps, often with no minimum deposit. Third, fund your account. Fourth, place your trade using the ETF's ticker symbol, like GLD, IAU, GLDM, GDX for miners, etc., and specifying the number of shares you want to buy, just like buying a stock.
Simple enough.
Then after buying, you just monitor and manage your investment as part of your overall portfolio, staying informed about the gold market, relevant economic news, and the specific ETF's performance and any changes in its strategy or structure. It's easy to add gold exposure this way through accessible apps and accounts.
Finally, the sources touch briefly on the Indian market context, specifically for gold.
Yeah.
What was notable there?
Yes, a source from Business Today provided some specific data points and predictions for the Indian market, which, as we noted, is a massive global consumer and holder of gold. At the time of that source, ICICI Bank Global Markets was predicting potentially significant increases in domestic gold prices for 2025, maybe reaching Rs 87,000, 90,000 per 10 grams in the first half, and possibly up to Rs 96,000 in the second half.
What was driving that optimism?
The outlook seemed driven by expectations of continued global economic uncertainty, potential U.S. tariff policies impacting trade, and strong underlying investment demand within India itself. Investment demand is noted as being particularly strong there.
And ETFs are growing in popularity in India, too.
Yes. The source highlights substantial inflows into Indian gold ETFs during the fiscal year 2024-25, citing 14,948 crore in inflows and a significant surge in the total assets under management, AUM, in these funds, reaching to 55,677 crore. So ETFs are definitely gaining traction as an investment vehicle there.
Interesting. How did the historical returns compare between physical gold and ETFs in that specific market, according to their data?
That Indian source presented an interesting finding. Historically, physical gold actually showed a stronger compound annual growth rate, CAGR, in India over certain periods. It cited 17.01% for physical gold from 2010-2025 and 12% annually over the last decade, compared to gold ETFs, which averaged 11.44% over 10 years and 10.80% over 15 years on average.
Why would that be?
Fees.
The source doesn't explicitly state why, but yes, the management fees and tracking error of ETFs would be one factor. It could also relate to how physical gold prices, often including local premiums or charges, are measured versus the net asset value tracking of ETFs. However, the source immediately balances this historical data by emphasizing that ETFs offer superior convenience and ease for pure investment purposes. Physical gold often holds significant value for traditional, cultural, or heirloom reasons alongside any investment motive.
So the decision might depend on your primary objective. Exactly. The source suggests the choice often depends on whether your main goal is having a tangible heirloom to pass down through generations, or if it's primarily a financial investment seeking portfolio return, diversification, and ease of transaction. For the latter, ETFs often win on practicality.
That historical data difference is interesting, but the point about convenience for pure investment is definitely key for many investors today, especially outside of cultures with such strong physical gold traditions.
Exactly. ETFs have undeniably lowered the barrier to entry and simplified gold investing for millions globally.
Okay, we've taken a really detailed look now at gold, oil, and agriculture, how they're influenced by global forces, the different ways you can invest in them, the pros and cons. But let's step back for a moment and consider something broader that seems to apply to all these markets: the critical role of timing.
Ah, yes. Timing the market. The eternal challenge.
The sources included a really interesting comparison, not directly of these commodities, but of investing in the S&P 500 stock market index versus investing in average Iowa farmland over long periods. While farmland isn't a liquid commodity you trade daily, its value is obviously tied closely to agricultural commodity prices and profitability. It provides a powerful, tangible case study on timing and asset class performance.
It really does. It gives a concrete, long-term perspective on comparing different types of assets. That Iowa State University Ag Decision Maker source analyzed what would happen if you invested, say, $1,000 in the S&P 500 stock index versus buying the equivalent value of average quality Iowa farmland over different starting periods, specifically tracking investments made in 1950, 1980, and 2010, and seeing how they grew through the end of 2022.
And what did that long-term comparison reveal about performance? Which one came out ahead?
It depended dramatically on when you started. If you invested $1,000 way back in 1950, by the end of 2022, the S&P 500 investment, including reinvested dividends, had grown to be worth approximately $1,976,333. The farmland investment, including both the appreciation in land value and the estimated net income from farming activities over those years, was worth about $1,429,899.
So over that very long 72-year time frame, starting relatively early, the stock market investment actually ended up with a significantly higher total value, about 38% higher in that analysis.
Correct. Stocks won that very long race starting in 1950, But
what about starting later? What if you invested in 1980? That was near a peak in land values before a major farm crisis hit the U.S. Midwest, right?
Exactly. And this is where timing becomes incredibly starkly apparent. If you invested that same $1,000 in 1980 near that historical peak for farmland, by the end of 2022, the S&P 500 investment was worth over $1,668. The farmland investment, however, which suffered through the farm crisis downturn, was only worth about $28,081.
Wow, that's a staggering difference.
It really is. In that scenario, starting at a high point for land values just before a major downturn, the stock market investment massively outperformed farmland. The final stock value was over 35 times higher than the land value. The land investment was only worth about 2.8% of the stock investment after that 42-year period.
That just drives home how much the starting point matters. What about a more recent time frame? What if you started in 2010?
In that case, starting in 2010, which was notably before another significant run-up in land values, but after the S&P 500 had taken a hit during the 2008-2009 financial crisis, the results were more mixed initially. Land actually yielded better total returns for the first few years, up until around 2014.
So land won in the short term then?
Initially, yes, but then as land values softened somewhat between 2014 and 2020 before rebounding again, the S&P 500 generally returned more over the remainder of that period. By the end of 2022, the S&P investment typically showed a greater total return over that full 12-year span as well.
So even over a shorter, more recent term, the relative performance shifted back and forth, and the specific starting and ending points really mattered for which one looked better.
Absolutely. The study also looked at volatility and the annual income component. Land values themselves changed by an average of 6.2% per year over the long term, with a standard deviation, a measure of volatility, of 10.6%. The S&P 500 index value changed by a higher average of 9.2% per year, but also with a higher standard deviation of 15.3%.
So the stock market had a higher average capital appreciation return, but was also significantly more volatile day to day or year to year than land values?
Correct. However, interestingly, the study estimated the yearly net return from farming activities, basically, the rent or income generated by the land after expenses like property taxes and management fees, averaged about 4.9% of the land's value annually. This was actually higher than the S&P 500's average dividend yield, which was around 3.1% over the same long study period.
That's a really interesting nuance. Land offered a higher average income yield, like rent, even if stock price appreciation sometimes led to higher total returns depending on the specific period you measure.
Exactly. It highlights different components of return. But the key conclusion from the source is powerful and unequivocal. Which investment was better, stocks or farmland, depended largely on the timing of when the investment was initially made and the year the investment was hypothetically sold or valued.
Timing is everything, or close to it.
Pretty much. Land performed relatively better during certain distinct economic periods, like the high inflation, stagflation era of the late 1970s and early 80s when commodity prices and land values surged, and also during the commodity boom years in the late 2000s. Stocks, on the other hand, performed much better during other times, like the recovery period after the farm crisis in the 1980s or during the more recent tech-led bull market gains. The length of the holding period also significantly influenced the outcome.
The study also makes sure to note other important non-financial factors for land ownership, right? Things like the security of owning a tangible asset, having something to pass down to heirs, maybe prestige, factors that aren't captured by purely financial return analysis.
Right, those add another layer of complexity to the decision for someone actually considering buying land. And accessibility is obviously very different. It's much harder to invest just $1,000 directly into buying a parcel of farmland compared to buying stock shares, although alternatives like REITs or crowdfunding platforms for farmland do exist now.
And importantly, they also highlight that both markets today, stocks and land agriculture, are heavily influenced by the same big overlapping set of major macro factors we've been discussing throughout this conversation.
Exactly. Things like volatile commodity prices themselves, global geopolitical events like the Ukraine war, rising interest rates being used to fight inflation, government budget deficits, labor market conditions, lingering COVID impacts, U.S.-China trade relations, global supply chain disruptions. All these macro forces add significant uncertainty to future return expectations for both asset classes.
This stocks versus land comparison really drives home how external events and the specific economic cycle we're in can dramatically alter the relative performance between different asset classes over time. How does this connect back specifically to our discussion about investing in gold, oil, and agricultural commodities themselves?
It's a crucial connection, I think. Just like that stocks versus land comparison shows so vividly, the performance of gold, oil, and agricultural commodities, and the various ways you might choose to invest in them, is profoundly influenced by those same major macro factors we've been discussing, and, critically, by timing. When you get in and when you get out matters. A lot.
How does that timing factor play out differently for each of the commodities we discussed?
Well, for agriculture, as we saw, it's extremely sensitive to weather cycles. El Niño-La Niña patterns were mentioned in one source's historical context. It's sensitive to specific supply and demand shocks related to things like outbreaks of animal diseases, which impacts feed demand for corn and soy, and shifts in trade policies or tariffs. Agricultural commodity prices can have periods of really dramatic increase, followed by significant declines. So timing your entry and exit relative to these cycles, which are influenced by unpredictable factors like weather or sudden trade disputes, is absolutely key and very difficult.
Right. And oil, which we already know is famous for its volatility.
Oil is perhaps the commodity most acutely sensitive to the overall health of the global economy, demand, and geopolitical stability or disruption supply. Its inherent volatility, driven partly by that price inelasticity we discussed, slow responses to price changes, means that the timing of your investment relative to unpredictable events like political conflicts, sudden recessions, or major technological shifts, like an unexpectedly rapid energy transition, is incredibly significant. Being positioned in the market at the wrong time relative to one of these major shocks can lead to very rapid and substantial losses.
High stakes timing there. And gold, often seen as the safe haven, how does timing affect it?
Gold's performance, as we discussed, is often countercyclical to the stock market and heavily tied to investor sentiment around risk and uncertainty. It tends to benefit most during periods of high economic stress, high inflation, falling real interest rates, or acute geopolitical crisis. Its very status as a safe haven means its price appeal is strongly linked to specific global economic and political conditions. So, timing a gold investment effectively often means trying to anticipate when uncertainty is rising or when real interest rates minus inflation, are low or falling, and potentially reducing exposure when confidence returns to the broader markets or when central banks raise rates significantly to combat inflation.
So it's really not just about picking your commodity, I like gold or I think oil is going up, but about deeply understanding the current macro environment, the specific factors influencing that particular commodity at that specific time, and how that relates to when you choose to invest.
Exactly. That Iowa farmland study shows so vividly how the best investment wasn't fixed. It depended entirely on the period you examine. The same fundamental principle applies to commodities. And, as we've discussed throughout, even within a single commodity like gold or oil, the choice of how you invest using futures, ETFs, buying stocks of related companies, maybe even holding the physical asset involves vastly different risk profiles, cost structures, tax implications, and levels of accessibility. All of that further complicates the decision.
It really seems the right approach, if there is one, depends entirely on your individual investment objectives, your personal tolerance for risk and volatility, and maybe your own perspective or skill or luck regarding market timing.
I think that's a very fair summary. There's no one-size-fits-all answer in commodity investing.
Okay, that brings it all together then. We've taken a really substantial deep dive today into the complex and fascinating world of commodity investing. We've explored the distinct landscapes of gold, oil, and key agricultural commodities.
Yeah, we covered a lot of ground, from how they're produced and used to the myriad forces that drive their prices.
We've seen how powerful global forces, everything from weather patterns and supply chain logistics to geopolitical conflicts and central bank interest rate policies, influence these absolutely fundamental markets.
And we've uncovered the various ways you, as an investor, can actually gain exposure, ranging from the high complexity and risk of trading futures contracts or CFDs
to owning shares in related companies like miners or oil producers, or accessing these markets more easily and perhaps more appropriately for many through exchange-traded funds, ETFs.
It's clear these are not simple markets. They have layers of complexity. But their foundational role in the global economy makes them incredibly compelling to understand, both for potential investment opportunities and simply for comprehending the economic world unfolding around us every day.
And I think the key takeaway, reinforced so powerfully by that comparison between stocks and farmland over different eras, is that there's just no single simple answer to which commodity or which method of investing in it is universally best.
Absolutely not. It fundamentally comes down to your individual situation and goals. What are you trying to achieve with your investments? Are you seeking primarily income, long-term growth, diversification away from stocks, a specific hedge against inflation, or maybe something else entirely, like holding gold for traditional reasons?
Right. And it depends heavily on your personal tolerance for risk and your ability to stomach the significant volatility that is just inherent in most of these commodity markets.
And as that data on stocks versus land showed so clearly, and as is undoubtedly true for gold, oil, and agriculture as well, performance depends, perhaps most importantly, on timing, both when you choose to enter the market and potentially when you might need or choose to exit. Performance can vary dramatically across different time periods and different economic cycles.
So considering how deeply intertwined these commodity markets are with often unpredictable global events and economic cycles, and given all the varied risks and potential rewards we've discussed today, how will you approach incorporating this understanding of commodities into your own investment thinking?
And maybe more fundamentally, what does that powerful influence of timing? The fact that when you invest can matter just as much as what you invest in, especially in these volatile and interconnected markets, mean for your own broader investment philosophy.
Something to think about.